and welcome to the another episode of Arjav. Arjav literally means straightness, sincerity, and harmony in one's thought, words, and actions towards oneself and towards others. And this is literally what DSP has always believed in: defining processes, defining frameworks, and standing true to those. Therefore, the investor knows the kind of philosophy they are getting into, and they know that there will be consistency that will be maintained. So today we discuss a topic that lost a bit of its credibility in the last few months and years. And to discuss it, we have none other than Mr. Vivek Ramakrishnan, who heads credit risk at DSP Investment Managers and is also a fund manager with us. So Vivek, welcome and thanks for joining us today. The word credit has lost its credibility, its charm in the post-ILFS world. What went wrong, and how is the analysis different today than it was years back? So, what did ILFS do to the whole credit space in general?
Yeah, hi Ankita, and it did go really wrong, right? You heard the word credit, and the next word you heard was default. I mean, there was nothing, it was said in one breath. And I think we need to look at what the world was just before the ILFS default. It was a very risk-seeking world. Equity markets were rewarding risk. Debt markets were looking at yields. NBFCs, for example, were loading on short-term debt and giving long-term loans. In fact, even some small banks, as you would know, Ankita, were borrowing wholesale in large sizes and gorging themselves on corporate and real estate loans. Sense went out of the window, right? And credit is about sense. And all it needed was one spark for that to go boom. And that came in the form of higher interest rates, as well as a high-profile default of a AAA company. Then everybody started doubting everything, right? The financials you believed until yesterday out of the window. Everybody was suspect. And it has taken a very long time for the dust to settle down. Now we are 4 years later after the ILFS default, right? And you look at it in four years, people are saying, wo band ho jayega, ye band ho jayega. But hardly anything has, in fact, things have become better. Remember, after the ILFS crisis, we also had a big economic shock in the form of the COVID lockdown. And companies have actually become more risk conscious, and that we can see in their balance sheets continually. So I think the world has changed, has learned some lessons, and markets, people don't learn lessons for a long time. We are supposed to repeat our mistakes, but things have improved significantly in the last few years, and we look in a better credit shape now than we were. At least we seem to know what the risk is.
Sure, Vivek. So, in life, sometimes perception is reality, but not when it comes to credit, is what I've learned from you. So what are the macro variables that affect credit risk and perception of credit risk?
That's an excellent question, Ankita, because macro variables do play a very important role when it comes to credit risk as well as perception. So let's take it into the two bits that you have referred to. First is in terms of what happens when the economy is not doing well, right? When the economy is doing well, everybody is happy, credits are getting paid, and things are pretty okay. Let's say inflation is high and the central banks have to raise rates. Slowly, that leads to economic slowdown. And I'm telling the economists this, which is not a good thing, but you know that. And the second order effect of it is that the marginal borrower always is getting squeezed out. And what is also happening is that you've heard of zombie companies internationally, right? So the zombie companies are getting flushed out as they're not getting funds anymore. That, on an aggregate level, leads to defaults. So that is at a very macro level, and we'll come hopefully later to what good companies do. Then you have the credit perception issue, or what we call credit spreads. What is credit spread? It's the differential in yield for a certain credit from a risk-free asset, which is usually a GSEC of a similar tenor. What happens when there is tightness in the market is that credit spreads start to widen. Ironically, It's only when the credit spreads are at the narrowest that investors are looking for yield and they're piling on risk. In fact, like we are fond of saying that if you want to buy a shirt, you buy it on sale. But if you want to buy any risk asset, you buy it at the most expensive times, right? So credit spreads tend to widen, and that's what happens when the macroeconomic slowdown happens. But there's also third associated risk, which is not macroeconomic per se, but it has to do with the risk of liquidity. And we all know what happened for one of the mutual funds when they could not meet redemptions. It was not to do with underlying credit, but as much as the liquidity of the underlying credit, which gets hampered during periods of slowdown, or when people sense economic vulnerability. So these are broadly the three things that happens on an aggregate level. The credit deteriorates, so you have to pick the right companies. Credit spreads usually start to widen, and it has its own demand supply dynamics, but generally they start to widen, and liquidity in the market comes down. So those are the three things that the investors have to remember.
Sure, Vivek. So now that you have defined the parameters that matter, within your framework and within DSP's framework, how do you decide whether to buy a particular paper or not? How big a concern ratings are for you? How do you, make sure that credit worthiness is maintained, and when do you sell? And also, if you can give us some difficult examples you've had to tackle, that'd be an extra bonus insight for us.
Hard. Now, Ankita, I've quietly used the word good companies a couple of times, and that was my hints that I was dropping in. So what is credit basically? I mean, I would broadly say if we can't print money and pay back your debt, that is credit. And credit rating itself is a measure of credit worthiness, which you can say has two components: the ability of the borrower and the willingness of the borrower. The ability is a sense of business and financial risk. I mean, I'll just put it simply. Let's say you take a commodity company and commodity prices go up and down. Obviously, the company makes a lot less cash flows when the commodity prices are down. So that has one impact. And let's say it's putting up a large capex when the commodity prices come down. The impact on credit risk will get magnified, right? Because the level of debt, it's a level of cash flows in relation to debt, and that deteriorates. So the ability comes down, and you'll have ratings going up and down. That's just one part of it. I think where at DSP we are putting in a lot of effort is in what we can broadly say is the willingness part. And for that, I have to use the big G, governance, right? It's the market's perception of the governance practices of a company that actually leads to whether this company would likely default or not. And that is a very important part of where we put in a lot of effort, reference checks and everything else. And once we assign a certain limit on a company after doing all the due diligence, we are on our toes constantly. So we look at various impulses that are there in the market, equity prices, whether the stock prices moved up and down, bond spreads, bid offer quotes, media articles, whether there are any sudden board or management changes which can be potential red flags. So we track that very, very diligently. Now, frankly, as a credit analyst, I would say that I'm not so fussed about a one-notch downgrade here or there because of cyclical reasons, right? I mean, at the end of the day, a good company will take some amount of risk. But what I would like not to see is governance-related risk. And in the post-ILFS era, for example, there has been like now an obsession with the AAA rating. My portfolio should be more AAA oriented. And that's what we request investors to go beyond. Because rating is also another opinion only, and it can go up and down. But has the fund invested in good companies of good governance that you can recognize? Once you do that, you're almost home.
Sure, Vivek. So I think you've made a very good point that, even AAAs have seen a history of default. So ratings are mattering to an extent, but going beyond that, seeking quality and governance makes sense. Now, if we look at sectors when we, invest into credit risk or funds that are investing into papers across sectors. Within financial sectors, somehow NBFCs catch a lot of limelight. Now, are there any particular challenges in NBFCs, and do you evaluate NBFCs different than you would, let's say, do other sectors such as power?
Yeah, absolutely. Yeah. And I feel really bad for NBFCs. Let me start off saying that NBFCs have done a phenomenal role, right, in terms of going to the unbanked, causing development. The credit scores that you see of people probably the first time new to credit was taken on by an NBFC. But when disaster hits, what does the media call them? Shadow banks. Gives Chinese examples. I mean, they're regulated by the RBI. So, NBFC is one sector, but it is difficult to analyze an NBFC company because it becomes a sectoral approach. If you have, let's say, a power company, let's say that defaulted, another power company would still probably get money unless there's some big systemic risk which is there. But if one NBFC defaults, a small NBFC, and you've seen it, big NBFCs default, the waves go through the entire sector. So that is the difficulty in analyzing the NBFC sector. And by and large, you will find a decent chunk of NBFCs in our portfolio. The NBFCs are generally volatile. They are more vulnerable to economic risks, macro risks, because they are giving it to a lot of slightly riskier customers. But there is much to look at, right? If you have granularity of portfolio, if your portfolio is diversified, if you have sensible ALM practices, and if you have taken the risk, but you have enough capital to take the risk, if you're conscious of liquidity, then the NBFC always comes through at the very end. In fact, even if you take the two high-profile defaults of the NBFCs that started this call, you have so many NBFCs that have survived, and they're lending to very risky segments. And so risk is something that you need to evaluate. And I think one phenomenal change that has happened in India is the emergence of fintechs and Aadhaar and credit bureaus and so on. I think earlier on, if I took a loan in, let's say, Tirunelveli, since I'm from Tamil Nadu, and ran off to some other place, maybe they won't be able to track me. But now I have an Aadhaar and I have a bureau's code. So I can be tracked unless I'm the great Houdini who kind of has a different avatar every time. So I think those kind of changes and the changes that RBI has made to the payment systems and so on, which has reduced the costs significantly. I mean, you must be remembering, Ankita, or maybe you don't because you're so young. But in the old days, when you gave a check, you had to wait for 1 week for the check to clear. Right? It would probably be going from now, it's like 30 seconds. If the transaction is not going, you're clicking your tongue, right? So the NBFCs are big beneficiaries of all this. And people say, okay, wholesale lending. And in fact, I have a bias saying wholesale lending is trickier, right? Because there's chunky loans. But there are excellent NBFCs that have managed this risk very, very well for many years, and they've developed an expertise. So as long as there's common sense, and credit is so much about common sense and good governance, you're okay. And you can even look at NBFCs positively.
Sure, Vivek. So you've actually given us the variables that matter. You've given us the framework, and you've given us a take on a sector which had a ripple effect and became the elephant in the room. Now, before we conclude, any final words? And I would also want to know what kind of investment case best suits credit risk funds.
So let me answer the final words very easily. Credit is a lot about sense and investing in the right companies. And the right companies is companies with good governance. And I keep saying that again and again. Most of the big defaults have happened because of governance-related issues and not because of ability-related issues. Though sometimes you do have ability-related issues. There's some kind of economic shock or a technological change and all, which you can't do much about, right? So once you invest in those kind of companies, you're completely okay. And we talked about spread risk and liquidity risk. If you invest in good companies, you'll always find a bidder in the market. Maybe the impact cost would be more than, let's say, a GSEC, a lot more, but you would find a bidder. And even the market differentiates, right? Between two AA's, as you know, Ankita, there's a huge difference in yields. It's a question of what the market perceives the liquidity and credit risk of the company and the sponsor and the management is. So what kind of companies you wanted to know best fit into a credit risk fund? The answer is easy, right? Good companies. And what we would say is re-emphasizes companies with good practices where there is a sufficient liquidity, where there will be a wide set of participants who are probably not mutual funds alone, because usually the same problem comes to several mutual funds at the same time. That would be the kind of companies. In fact, going beyond credit risk funds itself, right? Even when you take any other scheme of a mutual fund, you can take a certain amount of credit risk. And in fact, in the short-term funds, in the shorter duration funds, we do take some amount of credit risk. They all might come under A1 plus, but the underlying rating may be a AA minus, AA, and so on. And each fund basically promises its investors a certain credit profile of a long-term rating and maintains it. That's the way DSP works. We deliver what we say we are going to do. And if that is the case, there is credit risk which is residing in every single fund, unless it's a GSEC fund, right? And you invest in the right companies, you'll get your money back. I think there's one question that you asked that I've ducked in terms of, can you tell me about a tricky situation?
Yes, I was about to come back to it. Could you please tell us a scenario where you had a difficult time and the framework wasn't just the framework wasn't enough?
So I have a theory, okay, and it's just personal, that credit analysts should be a bit of a worrier also. You should worry a little about what's going to happen. I mean, this is no point being overconfident. We've had certain situations which have arisen where the credit rating got downgraded recently, and there was a lot of worry in terms of what would happen. And this was an NBFC. But the promoter stood so strongly behind the NBFC. There was a chunk of retail in the portfolio. So bam, 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 month on month, money kept coming in, so that assured of liquidity. And the problem worked itself through. So that gave me a recent nervous time. But I would say that it's not been so dire. So, all of us on the call should touch wood and hope that happens. But again, if to re-emphasize the same point, and a good sponsor who's following the right governance practices will come out of the woods. There will always be somebody to back that sponsor.
Sure. Thanks, Vivek. I think you've given us enough food for the thought for the evening. And I think at DSP, we re-emphasize on it that in the long term, it is the rules that rule. And we take pride in having fund managers who have, created the rules that they stick to. So thank you, Vivek, for joining us today, and happy investing, everyone.
Thank you, Ankita.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.